It's been FOMO. It's been 2 months of straight up, and on Twitter I've been calling it, teasingly, the magic risk-free Fridays. We haven't had a single Friday in 2019 that actually has any downside to it. We tend to, this is just going to the structure of the way the market has been. We've been seeing a lot of job owning, frankly. It's probably the most job-owned market in history. We've had, on the one hand, non-stop dovish Fed speakers, and then on the other hand, we get headlines every other day about a imminent China deal. And so we see these gap ups. A lot of them happen Thursday night into Friday. And then the VIX gets crushed into the end of the week. Basically, we have the lowest VIX reading at the end of the week. There's no risk perception. So for the first time now, we're seeing a level of resistance approach markets. And obviously, we're massively overbought now because there has been no price discovery. And we still, despite some of the weakness this week, haven't had any real serious technical retest of this rally yet.
Sven, I want to go through some of the things that you sent me as a note that you're looking for today. One is that the S&P 500 just rallied back to those broken bull market trend lines. Why does that matter to you?
Well, to me, the whole question whether this is a bear market rally or the beginning of a new bull trend is still very much open. What we saw in December after this big fast correction of 20% off of the September highs, we actually saw a break of the long-term 2009 bull trend on a logarithmic basis. For technicians, that's a big fat warning sign. And typically what you see after lengthy bull markets, when a trend breaks, you see what is termed a aggressive counter rally. This is where the oversold conditions get alleviated, everybody gets optimistic again. Right now no one thinks about what happened in December anymore, right? Everybody's bullish again, looking for bullish targets. And it's not uncommon to see rallies of 20, 25% even off of these initial break lows. And that's exactly what we've done just now. We've rallied 19, 20% off of the December lows. And the break of the trend line resistance in December 2009, we just rallied back up to that trend line, and it's now resistance. And ironically, this is now where we're rejecting here this week. We've tested it twice, last week and then early this week, and now we're seeing some pullback. So we'll see if this is more meaningful.
You're also seeing some divergence here. I mean, the transports are seeing their longest losing streak in 10 years. The high yield credit market is seeing new highs as well. And you're seeing the markets are not making those new highs. How do you account for all these diverging data points?
Well, to me, it's kind of a deja vu to last year. Remember last summer, we've had new highs happening across the board, but there were divergences building in August and September that were largely ignored. And as I said last summer too, was that divergences don't matter until they do. And then once they do, they pack a punch. And that's what we saw last fall. And what we're seeing now is a different set of divergences. Transport is one of them, because last year actually transports made a final high before the market itself. And transport started selling off while the market still moved on higher. We're seeing a similar pattern now because the transports have actually already broken their uptrend so far in 2019. So it's kind of a warning sign. And the question is, are we repeating here? With high yield credit, this is a specific divergence because last year, actually when high yield credit like junk made a new high, markets made a new high. So there was a very closely correlated action going on. What we're seeing this year is high yield credit made a new high, but markets haven't.
One more thing here. Much of this rally has really been driven by corporate buybacks. The window for those buybacks is closing. How is that going to affect the liquidity that we see in the market?
Very good point. We had, again, as in last summer, for example, we had a relentless move higher amid volatility compression, and much of this was supported by buybacks. And then when buybacks have blackout windows, when earnings come up, we have Q1 earnings coming up here, obviously at the beginning of April. And so buybacks will stop. There's a blackout window. And to the extent that much of this rally has been driven, not by glorious fundamentals, which obviously we are not seeing that this year at this point, but by buybacks coming in record amounts, and that portion of the liquidity then being removed from markets, we may see some additional weakness in markets in the weeks ahead.